Live from Sydney, I'm Paul Allen. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Coming up, the US pursues a third tanker near Venezuela as President Trump intensifies the oil blockade targeting Nicolas Maduro's government. We assess the impact with Geopolitical Futures Chairman George Friedman. Asian stocks rise as traders gear up for the holidays with high hopes for a year-end Santa Claus rally. The AI trade in focus as well, with China's More Threads unveiling a new generation chip lineup set to challenge developers' dependence on Nvidia. And we'll get market insights for 2026 with SGMC Capital CIO Ed Gomes, who sees strong resilience in the technologies powering today's productivity gains. Also, India's institutional real estate investment topping $10 billion this year to set a second straight record. We'll take a deep dive into the outlook for the sector with JLL's Lata Pillai and Sonali Rawal from Anand Rathi Private Wealth. Well, we're keeping an eye on commodities, both gold and silver, both hitting fresh records, and this as rising geopolitical tensions enhance the haven appeal of precious metals. Oil prices also in focus today after Bloomberg reported that the US is still pursuing a third oil tanker near Venezuela. President Trump has been intensifying an oil blockade on Nicolas Maduro's government. For more, let's get to our oil trading reporter, Rongwei Neo in Singapore. So, Rongwei, talk us through what happened over the weekend. What are the latest details?
Well, so it's been quite an action-packed weekend with the US administration boarding a tanker carrying Venezuela crude on early Saturday, as well as right now, as you've just rightfully said, Paul, it's in pursuit of a third tanker. So this is not exactly a surprise, as it comes right after the Trump administration has said that it will implement a blockade on sanctioned oil tankers carrying oil out of Venezuela. And of course, this comes as the US administration is amping up pressure on the Maduro's administration, trying to cut off one of its most revenue-generating stream. Well, in this case, that's the oil trade. So once exports from Venezuela are curbed, experts expect that the oil storages in Venezuela will start to fill up, and eventually this would kind of cause or force them into closing several oil wells, which is of course expected to hit the Maduro's administration quite heavily. I do have to note that one of the surprises that we've seen over the weekend was actually one of the tankers that was boarded, Centuries, which was boarded on Saturday, was actually not on any official sanction list. And of course, the ship it has links to a Hong Kong-based entity, and this perhaps casted a spotlight on whether the US administration, apart from ramping up pressure on exports coming out from Venezuela, it also kind of hints at the fact that they could be possibly taking more heavy-handed actions further downstream, which of course includes the buyers of Venezuelan oil.
Yeah, you mentioned the importance of Venezuelan oil to Venezuela, but in a global sense, it only accounts for a tiny fraction of supply. So what's the wider impact for oil markets?
Right. So one of the interesting dynamics that Venezuela play in the global oil market is the fact that, of course, one, it's an OPEC producer, which means it's one of the major producers in the world, although that market share that it has once owned has slowly dwindled over the years due to several factors such as sanctions and whatnot. We do have to note that Venezuela is home to the largest known oil reserves globally. And of course, right now, it mainly supplies oil to two major countries, China as well as the US, with China taking the bulk of the oil. Of course, we have seen in oil prices today that it has edged up slightly, possibly on enhanced geopolitical risks and fears due to the additional tanker actions being taken by the US administration. But overall, in the long term, when I spoke to Chinese buyers, as well as wider observers of the Chinese market, it's not widely expected to affect supply, because this comes at a time where the demand coming up from China is low. Chinese private refiners mainly take in Venezuelan heavy, sludgier crude to create bitumen. And right now, the downstream market for that product is kind of weak as well.
All right, oil trading reporter Rongwei Neo there in Singapore. Well, our next guest is an internationally recognized geopolitical forecaster and strategist on international affairs, and he has briefed numerous military and government organizations in the US and overseas. Let's get to George Friedman, founder and chairman of Geopolitical Futures. George, thanks so much for joining us today. I just want to pick up on what Rongwei was saying there about the US pursuing this tanker. The Bella 1 says it was sailing under a false flag. How do you see Venezuela responding to this type of pressure?
Well, I don't think Venezuela is in a position to respond to anything. I also think that the amount of naval vessels in the Caribbean are far more than necessary for blockade, whereas the number of troops there are far less than is needed to invade Venezuela. Therefore, I suspect there's another dimension to this, which is cutting off Venezuelan oil heading to Cuba. The first ship that was intercepted was going to Cuba. And we are, I think, in the United States, putting pressure not only on Venezuela, but also indirectly on Cuba.
That's an interesting theory. Can you unpack that a little bit more for us? What's the motivation of the US wanting to put pressure on Cuba at this stage?
Well, Cuba has always been a dangerous geography for us. At the same time, recently, after the U.S. threatened to send more missiles to Ukraine, the Russians signed a new treaty with the Cubans on defense matters. And there is a concern in some quarters of Russian missiles coming into Cuba again, as they once did. And therefore, I think at this point, when the focus is on the Western Hemisphere rather than the Eastern Hemisphere, as Trump has put it, we want to more than deal with Venezuela, although that's part of the story, but also deal with the Cubans.
So, a similar question then that I posed you about Venezuela. How do you see Cuba reacting to this pressure, if you're correct? And could Cuba not just source its oil from elsewhere?
It could possibly do so, but not very quickly. But the situation inside of Cuba is pretty bad. There's a great deal of poverty in Cuba. Frequently, electricity is unavailable for extended periods of time. There's a healthcare issue. And the Cuban government at this point is pretty weak and unstable in my mind. Therefore, this happens to be also a time not only to deal with the Venezuelans and the cartels, but also to deal with Cuba.
Do you think the US is pursuing regime change in Cuba? And if yes, what would an alternative government look like?
Well, the United States has always wanted a regime change in Cuba, ever since the 1960s and the Cuban Missile Crisis. They were unwilling to pay the price to do it, but given how weak Cuba is right now, this might be a chance. The nature of the regime after that would be fundamentally, if possible, and not anti-American, as the Cuban is. And therefore, it would also send a signal to Latin America that when we speak about turning to the Western Hemisphere, we're turning our power on the Western Hemisphere.
The focus on the front pages at least, is still Venezuela, however, and President Trump has described the Maduro regime as a terrorist organization. So is the same goal there to pursue regime change in Venezuela? And also the same question, if not Nicolas Maduro, who?
Certainly, they would like to replace Maduro. And for the same reason, the Russians have a great deal of influence with Maduro as well. He's very close to them, as well as being the source of shipment of drugs to the United States, most of those drugs being grown in Colombia. Therefore, there's a broader picture than just the Venezuelan question. And as to what will replace it will obviously be a very complex issue, But if the United States has the ability to overthrow Maduro, it will have the ability to install a pro-American government, probably.
What's your timeline for all of this reaching some sort of denouement? Because as Wrongway was saying, if Venezuela's unable to load tankers, oil's just piling up on shore. It may lead to the need to shutter wells. What's the timeline in terms of how you see this playing out?
I would say weeks and months. The first issue being Maduro, and the second issue being how we have influenced Cuba, what we are after. If we are after basic undermining of both the Maduro regime and the Cuban regime, it'll take several months probably. But then
George, there's a few.
Venezuelan oil might start flowing again after regime change.
George, there's obviously plenty of other geopolitical tensions around the world that we need to discuss, also involving Russia. And I just want to talk a little bit about the progress of peace talks between Russia and Ukraine. I mean, the U.S. Special Envoy Steve Witkoff said there were productive and constructive meetings between European and Ukrainian counterparts in Florida. But is what was discussed there going to be in any way acceptable to Russia? Is this moving things forward at all?
Well, two things. The Russians have failed in their mission. Having fought for 4 years and only conquered this part of the country shows the weakness of the Russians. At the same time, Trump wants to make a settlement. Putin, on the other hand, cannot make a settlement after spending 4 years at war and countless Russian lives and barely taking any serious territory from Ukraine. Remember, most of that territory is not yet held by the Russians, by far most of it. And at the same time, when you take a look at the intentions of the Russians, they invaded the entire country, including attacked the capital in Kiev, and were beaten back. So I think the Russians have a real problem on their hands. Their military is not that strong. It has not succeeded even slightly in 4 years.
At the same time, they're also not going backwards, and Vladimir Putin's showing no sign of wanting to throw in the towel here. So what's your expectation for a peace process in 2026? And can it involve any ceding of Ukrainian land to Russia, which Ukraine would find unacceptable?
Well, at this point, the war has to end. The Ukrainians cannot push the Russians out. Russia has not shown the ability to advance forward. It's a frozen war. At the same time, the fundamental question is not U.S. politics or Ukrainian politics, it's Russian politics. The Russian economy is in very bad shape. The number of people who have been killed in the war are in bad shape. Now the Russians are recruiting people from Africa and other Asian countries to be in the military. That's not because their military is doing well. And so the question is, how long will the Russian public, the people around Putin and so on and so forth, allow him to extend the war because if it ends now, it ends in basic defeat for Russia, even if they hold this territory in Ukraine.
What's your outlook for European defense spending in this environment? And given the way you just characterized the Russian economy, how well positioned is it to engage in an arms race?
It's quite well positioned. The European Union's GDP is slightly larger than the Chinese. The question is, and this is the fundamental question we're facing in the world, does Europe unite and create a single European army and a single European government, or does it remain in various shattered relationships with each other, different, unable to reach a certain end? The fundamental question is, when you say Europe, Europe is a continent. It's not a nation.
Yeah, indeed. There's not always alignment on every issue. Even if peace were agreed, however, how can a guarantee be reached that Russia's not going to try again, potentially within the decade, to carve off another piece of Ukraine?
The Russian army has showed itself incapable of conquering a much weaker country. The threat of Russia that exists, which the Russians really want to maintain, is that somehow he's going to throw forces in all over the place and threaten Europe and threaten other areas. Given the performance of the Russian army in Ukraine, that's pretty unlikely. So we continue to feel that the Russians are somehow capable of very many things that they're really not capable of. They couldn't take Ukraine.
All right, George Friedman, founder and chairman of Geopolitical Futures. Thanks so much for joining us today. And let's stay with geopolitics. Thailand's military has reportedly struck targets in Cambodian territory over the weekend, including bombing a casino and a bridge. Bloomberg's Southeast Asia managing editor Katrina Nichols is right here in Sydney with us for more. So, Katrina, bring us up to speed with the latest developments over the weekend. And I've got to observe, striking a casino seems like an odd move.
It does on the surface of it. That's certainly true. So we've got reports that the Thai Royal Air Force carried out airstrikes on at least two significant targets inside Cambodia. One was the Ojek Bridge that's been described by the Thai military as a strategic supply route. And the other, as you mentioned, is a casino complex and some other facilities, and they were hit on Saturday, with Thailand asserting that these sites had become bases to support the Cambodian military operations. Cambodian officials, meanwhile, have condemned those actions as attacks on civilian infrastructure. The conflict, which really began escalating again earlier this month, it's well into its second week now, has involved heavy artillery and drones on both sides, and now has displaced hundreds and thousands of civilians, about 750,000 on both sides, and 40 people have perished in the clashes. As you mentioned, casino is a somewhat random thing to be hitting, but Thailand has increasingly framed part of its offensive as a war on scam centres and linking some of the facilities that it's been targeting, particularly these casinos, to transnational cybercrime and fraud networks. And that adds a pretty complex security dimension to what essentially started off as a territorial dispute.
Now, we've also got ASEAN foreign ministers meeting today to try and broker an end to this. How realistic is that outcome?
Yeah, well, today all attention, of course, swings to Kuala Lumpur and the ASEAN foreign ministers meeting that kicks off there right about now, actually, and is expected to last several hours. This is seen as the most tangible chance yet to secure a formal ceasefire and halt the recent escalation along those disputed borders. The diplomats hope the meeting will certainly reinvigorate dialogue after previous agreements have faltered, and they're framing the talks as being really critical for regional stability.
President Trump's previously taken an interest in this conflict. Is there a role for the US in helping broker an end to it?
Well, of course, earlier this month, President Trump did call the leaders of both Thailand and Cambodia and urged them to stop the fighting, and indeed said that this would help de-escalate the situation. Now, that didn't happen. The fighting just continued on. You have to wonder whether those peace negotiations are linked to tariff and trade discussions. The Prime Minister of Thailand, Anutin, certainly said that was not the case. But let's see if the US weighs in again.
All right. Bloomberg Southeast Asia managing editor Katrina Nichols there. Next up on Insight, the Trump administration defends removing an image of the president from its latest release of files tied to Jeffrey Epstein, saying the move was to protect victims. Much more ahead. This is Bloomberg. Welcome back. You're watching Insight. Here's another story we're watching. The Trump administration is defending its move to pull several pictures from the latest release of documents related to Jeffrey Epstein. An image of a desk drawer with a number of photos, including one showing President Trump, was among those removed from the department's website before being restored. Deputy Attorney General Todd Blanche says it was done out of concern for Epstein's victims.
You can see in that photo, there's photographs of women. And so we learned after releasing that photograph that there were concerns about those women and the fact that we had put that photo up. So we pulled that photo down. It has nothing to do with President Trump. There are dozens of photos of President Trump already released to the public, seeing him with Mr. Epstein. He has said that in the 90s and early 2000s, he socialized with him. So the absurdity of us pulling down a photo, a single photo, because President Trump was in it, is laughable.
The latest release of the so-called Epstein files includes thousands of pages and pictures, phone records and notes from investigations, but with many of those documents heavily redacted. Bloomberg's Miles Miller has more on the release and the reaction.
The Justice Department releasing a new set of documents tied to Jeffrey Epstein, marking the most extensive public disclosure yet in a case that's fueled political tension for years. The files were posted online after Congress passed legislation in November forcing their release, overriding long-standing resistance from the Trump administration. Trump ultimately signed the bill under pressure from Republican lawmakers who had demanded transparency around Epstein's case. What's new is the scope of what's being made public. The Justice Department releasing thousands of pages of materials from federal investigations into Epstein, the financier and convicted sex offender who died in a Manhattan jail in 2019 while awaiting trial on sex trafficking charges involving underage girls. Authorities have ruled his death a suicide. The records include investigative files, flight logs, travel documents, internal Justice Department communications, immunity agreements, and materials related to Epstein's death. Much of it previously sealed or only partially disclosed. The response was immediate, with users trying to access the documents being placed into online queues as traffic overwhelmed the Department of Justice website. Officials emphasized that this is not the final release, with Deputy Attorney General Todd Blanche telling lawmakers the volume of materials to be reviewed meant that it wasn't possible to meet the law's requirement to release all files by Friday. He said more documents are expected in the coming weeks as officials continue to review records to protect victims and avoid compromising ongoing investigations. Among the materials released are photographs and records involving prominent figures. One tranche includes a photo of former President Bill Clinton with the late musician Michael Jackson. Clinton has denied knowledge of Epstein's crimes. The release carries political risk for Trump, who has acknowledged a past social relationship with Epstein, but says he had cut ties with him decades earlier. Earlier disclosures this year were criticized as incomplete, fueling anger within Trump's base. With more records still under review, Friday's release is unlikely to be the last chapter in the Epstein case.
That's Bloomberg's Miles Miller. Let's take a look at how Asian benchmarks are tracking at the moment. Pretty good day to close out, the final trading week of the year, effectively, the final full one anyway. We've got the Hang Seng Index better by about 1/5% there. Stocks in South Korea performing particularly well, better by 1.7%. We did have some numbers out of China a little bit earlier for the 1- and 5-year loan prime rate. Those were both unchanged. A little bit later on, we're going to have CPI numbers for the month of November out of Hong Kong as well. Now, we've got an ongoing rally happening in gold, fueled in part by ongoing geopolitical tensions linked to what's happening with the oil price as well. As we were discussing earlier, the US is now in pursuit of a third oil tanker, this one the Bella 1, which the US accuses of sailing under a false flag. That blockade off the coast of Venezuela intensifying, and it will soon start creating problems for Venezuela, as if it's unable to load tankers, oil's going to start piling up onshore, potentially leading to shuttering of some wells. Still to come, Chinese chip maker More Threads unveils a new generation chip lineup. It's a fresh challenge to NVIDIA. We'll have details of that story next. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick look at where markets stand. We do have China going on a lunch break. Japan is coming back online as well. So we're seeing pretty much a strong risk-on sentiment across the region at the moment. The Nikkei better by almost 2% at the moment. We've got Chinese stocks doing pretty well as well. The CSI 300 better by 0.8%. The Hang Seng also moving higher by 1/3%. If we take a look at the yen there towards the bottom of your screen, 157.45, pretty weak. It has been range bound, but we did hear from the Japanese Finance Minister Katayama signalling concern over rapid one-sided FX movements. And this was after we didn't also get a lot of guidance from Governor Ueda on Friday about where the neutral rate in Japan lies after we had that 25 basis point rate increase, which pretty much everybody was expecting. Now, a lot of the action happening in the precious metal space again. Gold has captured a fresh record high, right now trading 4,389 an ounce, and is taking other precious metals along for the ride as well. Silver advancing also just shy of $69 an ounce now, and even platinum performing pretty well, advancing an 8th straight session, and it's cracked 2,000 an ounce for the first time since 2008. Well, China's More Threads has introduced a new generation of chips aimed at reducing AI developers' dependence on NVIDIA's hardware. Let's get to our China correspondent, Min Min Lo, with more on this. So, Min Min, tell us about More Threads' new chip and how it compares with NVIDIA's product.
Yeah, so More Threads is launching 2 new chips, the Lushan and Huashan, which are named after Chinese mountains. The Huashan chips are meant for AI inferencing and training, and the CEO says that it is better than NVIDIA's Hopper series chips, including the H100 and H200, and that it's closing the gap with the current Blackwell architecture. So this is pretty significant because if China already can do better than the H200, that eliminates the need for Chinese companies to buy from NVIDIA, even after the company had gotten that approval from the Trump administration to sell to China recently. More Threads also unveiled a new generation of chips for graphics processing. That's the Lushan chips, which it says is able to perform 15 times better than before. It also unveiled this GPU architecture that could enable the linkage of 100,000 chips in a supercomputing cluster that is supposed to be 10 times more energy efficient and have 50% increase in computing capacity as well.
So what are the implications for NVIDIA in China here? Because, Jensen Huang's already said that he doesn't expect to sell anything there. Is that going to be the case for the foreseeable future after these developments?
Well, it really depends because the Trump administration has given the green light for NVIDIA to sell to China. But the problem is the Chinese government hasn't really provided a clear guidance to its own companies whether or not they will be allowed to buy from the US, because the previous round, the H20 chips, the Chinese government had basically told its companies not to buy. We know the Chinese government has been meeting with Chinese tech companies to assess their need for the H200 chips and asking them to justify in some sense why they want to buy from NVIDIA as opposed to homegrown chips. And I think More Threads, by offering something that is equally advanced or if not better than the H200, it really reduces the chance of China approving the H200 for purchase in China. So question is what is next and whether or not NVIDIA would push Trump to allow for the Blackwell series of chips to be sold in China, but that we know has gotten quite a bit of pushback from US lawmakers so far.
Yeah, there's also getting pushback in terms of listing some of these names as, relating to military production in China. What are House Republicans saying about this?
That's right. So Republican lawmakers have been lobbying the U.S. government to add 19 new companies to a Pentagon list that would list these companies as Chinese military companies. So among them include DeepSeek, the robotics firm Unitree, some of the firms that you see on the board there. Wuxi is a pharma company, Xiaomi as well, RoboSense. So these are pretty wide-ranging sectors that are affected. The implication is the Department of Defense will not be able to start new contracts or renew contracts with these companies. But for other regular companies, it also sends a signal, right, a warning signal for them about the risk of associating or working with some of these companies. So certainly this is something that could worsen ties between U.S. and China. And it's very hard to get off this list because we know that Hesai, for example, the Chinese LiDAR company, has been one of those that had sued the Pentagon for including it on the list. And it claims that it does not have relationship with the Chinese military. yesterday, it successfully got off the list, but then it was immediately relisted. And that shows you the stickiness of the label and how hard it is to really challenge the Pentagon on this.
All right, Bloomberg's China correspondent Min Min Lo there. Let's get some more market insights from Ed Gomes, CIO of SGMC Capital, a multi-family office. Ed, thanks so much for joining us, and I do want to start on some of these themes in the tech and AI space. First off, we always mention AI in the same breath as a potential bubble. Can this rally continue? Are we in bubble territory? Can you give us the case for each potential scenario, and which do you believe?
So the way we look at bubbles, clearly there is a lot of enthusiasm for anything which is AI, and that in itself is problematic. At the bottom of the markets in 2022, 2023, people were talking about AI, but not too many people were interested in buying because you had just gotten into a massive decline in the NASDAQ of around 30%. Today, you say AI and everyone's willing to throw money at almost any project. So clearly, projects which will fund fairly weak technologies, sometimes borderline fraud. Investors have to be very, very clear about what they're funding. But when you have companies which are delivering very, very solid products, services, and have a very clear sight into what the future will hold, not just for themselves, but the overall wave of technologies, then yes, valuations could get stretched, but most of these companies will bounce back from any kind of sell-off.
There's also a monumental amount of spending going on, and we have a chart on the Bloomberg terminal that illustrates this. Hyperscalers are seen spending another $500 billion in capex over the next 12 months. That's $500 billion. Okay, they're building out, but do you have any concerns about this, some of the circular deal making that sometimes seems to be involved, or questions about where all of this money is coming from?
I think, before I answer those, what exactly is this going to fund? So yes, it is going to fund physical infrastructure. There are going to be chips, there are going to be data centers, there are going to be cooling solutions which are put in place. And all of those obviously have a limited life cycle. You also have the entire debate about, whether these are being depreciated or amortized appropriately or not. And, that it does require some amount of thought. But at the same time, a lot of this is powering, and if you look at the OpenAI information which has come out just overnight, they're willing and able to sell more and more paid licenses, whether it's in the enterprise space or in the personal commercial space. So you have a lot of take-up for this, and a lot of this is powering massive amounts of intelligence creation as well. If you look at what DeepMind is doing, and the entire team at Google, their ability to fold proteins and crack problems which have been intractable for decades is just a testament to the power of these technologies. So clearly there's a build-out which happens, but at the same time there's a lot of positive development in terms of deployment of the technologies as well.
When you're looking at allocating investment to this space, in geographical terms, where do you look? Do you prefer the US names, or are you looking more towards Asia, Japan, Korea, and China as well?
The bulk in the US, just for the simple reason that the information flow from American companies, disclosures, CEOs speaking to analysts, as well as CEOs speaking to the media broadly, it does provide a much richer backdrop on which to base estimates or to base analysis. When you're looking at Japan, South Korea, and Taiwan, I think they're extremely interesting areas, and we do have some exposure to those names as well. But the bulk of our investments are currently in the US.
You mentioned transparency there, and I brought this up with Min Min a moment ago in terms of Jensen Huang's remarks around NVIDIA sales into China. I mean, he's not expecting any. Do you consider that that's going to continue to be the case for the foreseeable future?
In the short term, yes, absolutely. Jensen would love to sell to China. He's been making a very, very strong case about how the US gets stronger by allowing NVIDIA technologies to proliferate. So clearly, it's a large market for NVIDIA. It was until the geopolitical problems started emerging. But at the same time, there's a lot of take-up of NVIDIA's technologies, regardless of whether the China piece kicks in or not. Our belief is that NVIDIA is, and Jensen Huang says this himself, you're looking at companies producing chips, which are great, but you also need to now consider NVIDIA as an AI factory and factory equipment manufacturer rather than just chip maker, because the entire ecosystem has gotten so complex. In terms of connecting data centers, in terms of connecting chips. We were talking about Micron earlier as well, in terms of the ability to connect and deliver the high bandwidth memory which is needed. So it's not just one product, it's not just one chip, it's the entire ecosystem. And let's not forget CUDA, which is their software coding platform, which allows optimizations to be made on those chips. So not really concerned about NVIDIA and demand at that point in time.
You mentioned, just to get back to your point about transparency, yes, the same level of transparency isn't there with these Chinese chip makers as you enjoy in the United States. But what is your outlook for more threads, Cambricon, DeepSeek and others? I mean, particularly in mind that the US keeps looking to try and to squeeze these Chinese chip makers on national security grounds.
Absolutely. It's a massive minefield, just the geopolitics of it all. And, AI chips is the current bugbear. Earlier it used to be soybeans, or earlier it used to be some other kind of product. But that we don't see this go away for a long time. Donald Trump has his style and his agenda. The Chinese Communist Party and Xi Jinping have their agenda. We don't take sides on that. Each country is always going to be pushing for its own advantages. So, the competition overall for consumers at the end of the day is clearly great, because what that means is you have, as you mentioned, DeepSeek as an open source models, which puts pricing pressure on all kinds of other proprietary model owners and developers. So that's great news for consumers. It also means it's great news for proliferation of these technologies across the economy. So it's not just technologists and technology companies which are using this. You have manufacturing companies, eventually, which will be able to squeeze out efficiencies in their entire supply chain or operations on the back of strong and powerful models. So, we look at that, and the competition is a massively positive development.
All right, Ed Gomes, CIO of SGMC Capital, is sticking around. And when we come back, we will get his insights on emerging markets like India, which has become one of the calmest stock markets in the world. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Let's take a look at how Indian markets are tracking at the open. Seeing a risk on sentiment here as well. The Sensex better by 0.4% in the early going, tracking much of what we've seen around some of the other major Asian markets this Monday. Also, the rupee back below 90 against the greenback. We did see the Reserve Bank of India rather enthusiastically getting involved in FX markets, and the RBI is going to be holding a $1 trillion rupee two-day variable rate repo auction starting today to inject liquidity as well. All right, let's get back to Ed Gomes, CIO of SGMC Capital, still with us. Ed, thanks for waiting. And I do want to start on some of that rupee strength, relatively speaking, or really dollar weakness is what I want to talk about, because we've got some of the big houses, JP Morgan, Morgan Stanley among them, seeing a lot of optimism for emerging markets in 2026 due to a weak greenback. Are you part of that club?
The long EM trade has been on, and there is some amount of correlation with the overall tech trade, and you do the correlation versus the Nasdaq has been pretty strong. But in general, just the demographics of countries like India are so positive that the government just needs to put in place the effective infrastructure which allows the rest of the country to go about just doing business, and that's what they're doing. So yes, we're very comfortable with Southeast Asia demographics as well as India. Those are markets that we really are building on positions as we build as time goes on.
That said, though, we've seen a lot of foreign outflows leaving India, certainly towards the last quarter of this year. Why is that happening, considering, as you say, that the longer-term growth story is a rather compelling one?
I guess some of it is just rebalancing to the extent that global investors, are also getting sucked into what might just be the sexiest trade out there, which is AI, right? So to the extent that India is a more infrastructure play, a more financial markets play, a more consumer-related play, yes, there is a very, very strong component of technology. There's a lot of economic activity which is in the technology sector as well, but that doesn't necessarily get captured in the markets. So we'd expect that some amount of those outflows would be related to rebalancing of portfolios, into like I said, the sexier part of the overall market story as of right now.
So when you're looking across emerging Asia in 2026, which market offers the most compelling growth story to you?
India for sure, and some of the recent elements of news which have come through about the hyperscalers investing hundreds of millions of dollars into India in terms of offices and hiring. That's going to be a big driver. You also have the recent news on the insurance companies being allowed to operate 100% owned entities out of India. It was earlier 74%. Already had a fair amount of control, but now it's like full control. That's going to drive investment. Again, like we mentioned, the demographics of the country will dictate that insurance is going to be a massive need in the coming years as the middle class just grows and delivers more economic prosperity. So that's going to be another area which is going to be very, very strong going forward. The banks in the financial system, just in terms of the credit lending, just given the propensity of the consumer to borrow money to buy, whether it's automobiles or even housing, is going to deliver massive amounts of economic growth as well. So we're looking at more less in the tech sector in these markets. We like Indonesia as well, so that's another market which is a strong favorite.
And what's your approach to China as well? Because, we discussed the positive story around AI in China, but at the same time, the country's still grappling with a serious deflation problem and an ongoing rolling problem in the property market as well. So how do you approach China as a market?
We tend to stick with some of the safer names, and we also tend to play the indices. We don't want to get involved at this point in time in terms of trying to find, the best stock in each sector. We're happy to play the index futures, options on the index futures, because that can give us the upside, without getting into micro name risks, which suddenly pop out of nowhere. So with China, equally optimistic. To the extent that the government focuses on a pro-business stance, we think the country can deliver, phenomenal gains for investors. But just at this point of time, we just prefer playing the indexes for portfolios.
All right, Ed Gomes, CIO of SGMC Capital. Thanks so much for joining us today with your insights. Well, the Adani Group is planning to invest more than $11 billion in its airports business by 2030. It's looking to bid for nearly a dozen new terminals, upgrade infrastructure and expand into aircraft maintenance as well. Let's bring in Bloomberg Conglomerate's media and telecom reporter PR Sanjay for more. So, PR, what are the details of this planned investment by Adani in India's airports?
So, Adani Airport Holding, the holding company of airport conglomerate, has huge plans. They want to invest at least $11 billion in next 5 years. And there are a lot of details. In fact, they want to successfully launch the new Navi Mumbai International Airport, which will be taking off. The first commercial flight will be taking off from December 25th, the Christmas day. And they also want to want to go for an IPO between 2027 to 28, and this IPO is relying to three things. One is successful commercial operation of Navi Mumbai International Airport and self-sufficient operations of the airport business as itself, and they also want to complete the city side development, including Aerotropolis, which will be giving more focus on retail, hospitality, etc. So that's one. And they are also looking at MRO opportunities to help the entire aviation landscape of India. And they hinted that they would want to get into the aircraft manufacturing opportunity. They say that it is very early. They are not actually tied up with any partners, but it will be done through a partnership model. It is slightly early position at this time, but they're hugely pinning hopes on airport operations, and airports would be the unit which will be demerged out of the conglomerate and will be taking wings of IPO.
So tell us about some of the features that will be being worked on as well, because this would really look to take India's airport infrastructure, propel it well into the future.
Well, I think that's a great perspective, because what Navi Mumbai International Airport would do is it will be, first of all, taking a lot of stress from the Mumbai International Airport. And India as an Indian aviation very badly need a hub, because it's a growing market, but it doesn't have a proper hub. So Adani would look at creating a hub with an anchor airline. For example, on Air India or Indigo, etc., could be an anchor airline. They would want to make Navi Mumbai International as an airport, because Mumbai Airport was always operating out of a 1.5 runway. Now Navi Mumbai will be having 2 runways, and have already appointed a consultant for the 3rd runway, which means this Navi Mumbai International Airport will be a very key critical milestone for not for just Adani, for Indian aviation as well, considering the plans and considering the Aerotropolis and IPO and financing plans what we are picking up right now.
Pia, can you also tell us about Adani's plans to expand in nuclear energy as well?
Oh, that's an interesting thing. That is another foray from the port to power conglomerate. They want to build small modular reactors. Adani's would be first among the private players which would be getting into this new landscape, which government has most recently okayed it. But it's Adani doesn't have that kind of a capability to run the plant. So what we are picking, what sources are telling us, India's Nuclear Power Corporation of India Limited would be running. They will be the operator, and the research wing of Department of Atomic Energy, Baba Atomic Research Center, would be designing these small modular reactors. And at the end of the day, Adani's might be getting some flexibility to sell the power generated out of this ambitious small modular reactor atomic plants.
Yep. All right, Bloomberg Conglomerate's media and telecom reporter PR Sanjay there in Mumbai. Still to come, Andrew Collier will share his views on China's property crisis as embattled developer Vanke enters a critical day, just hours now to avoid default. We'll also get the outlook for India's real estate markets as well. This is Bloomberg. Welcome back. You're watching Insight. Let's take a look at how Asian markets are performing at the moment. Pretty well. A lot of green on the screen. Looks like we're heading into a year-end rally. The only thing that's a little softer is the Japanese yen, but we see the Nikkei having a good day, better by 2%. Even the Indian rupee strengthening, back below 90 against the dollar. Precious metals in particular having a moment. Gold and silver both hitting fresh records. Silver now not far off $70 an ounce. Crude prices rising, as well as we have the United States continuing to pursue a third tanker off the coast of Venezuela that it accuses of sailing under a false flag. Well, it is a pivotal day for Chinese developer China Vanke as the grace period for its December 15 bond payment deadline expires. If creditors don't agree to an extension, Vanke could be tipped into default. Let's get to our managing editor for Asia Equities now, Lianting Tu. So, Lianting, when do we expect to have the results of a vote?
Yeah, the vote already should be in by 10 o'clock Hong Kong time, but actually the filing will come out much later in the day because the votes will be tallied. And so we expect something after 4 p.m. Hong Kong market close, but it could come out late in the day. So we're all prepared for that. But overall, the whole vote is really about whether to grant Vanke a bit more time to forestall a default.
So what's the expectation of that? Is Vanke going to get the time that it's looking for, and how likely is a default? And if there is a default, what's the fallout going to be?
Yeah, specifically, as you said, there's going to be a vote on whether to allow Vanke to delay the bond payment on that 2 billion yuan bond by 12 months, or to give it until January 28th to renegotiate terms with its creditors. So overall, if Vanke ends today without a deal or an agreement to extend the bond or no payment, then really, I think bondholders can potentially call default on Vanke. And if there's indeed a default, I think it's just going to be a further shakeup in sentiment among investors in China's real estate sector, because Vanke is a state-backed real estate developer, and it used to be the biggest in China. And Shenzhen Metro, its a big state backer, used to really committed to backing Vanke, but suddenly halfway it reduced its commitment. So that is sending a very strong signal among investors whether those state-backed real estate developers really has that state backing when they really need it.
How much could bondholders and creditors potentially lose here?
Yeah, it could be a lot. If you look at the bond prices, those onshore bonds are already trading at around 20 yuan. So that is a drop from about 80 yuan just about 2 months ago. So you can see people are already pricing in about 20% return. And Vanke, in addition to a lot of bonds, it also has a lot of bank loans, which are actually pretty much backed by its property assets. So bank holders obviously will be a little bit more senior to bondholders. But yeah, if you look at bond prices, it's really not trading with much value left.
All right, Bloomberg Managing Editor for Asia Equities, Lianting Tu, as we await the publication of that vote. Our next guest has been closely watching the China property crisis, including Vanke's situation and the lack of bailouts. Let's get insights now from Andrew Collier, Senior Fellow at the Harvard Kennedy School. Andrew, if you were a betting man, how would you say that today's vote is going to go? And is Vanke going to get more time to come up with the goods on that bond?
My guess is that they're not going to win on this vote. I think bondholders have decided that there's no point in extending and pretending anymore, that they might as well take the hit now and see if they can restructure the debt and get something out of it, rather than letting this sort of foolish scenario continue. So the real question is, what's the attitude of the central government? That's the question. The central government appears to have taken the view that it's up to the provinces to handle all these problems. And given the lack of revenue in the provinces from the collapse in land sales, the local governments in Guangzhou and elsewhere, and also companies like Shenzhen Metro, are basically saying, look, we're out of money, so we just cannot help anymore.
So just to be clear, you're expecting to hear of a default this afternoon?
Yes, I think they'll probably be driven into default. Now, it's possible they'll try to figure out some sort of compromise, but I don't quite see what that is, because most of, as Lianting probably knows well, most of their assets are tied up with other commitments, and so there's a limit to what they can really offer to bondholders at this point.
Is default in some ways potentially the best option here? Because Bloomberg opinion columnist Xu Liren was writing last week that it'd be better just to get this over with rather than eventually all the assets just shrink away to nothing.
Well, I'm concerned with the long-term future of the Chinese economy based upon the collapse of the property market. I've just finished a book, and essentially the downturn is taking a 31% hit in GDP, And this kind of scenario, even if they're not listed companies with bonds, is occurring all across the country, where there's defaults of all sorts of natures, and then or non-payment of goods. And I'm getting concerned both about the potential for unrest in parts of the country where they've run out of money, and also what's the impact on the banks. Most people, analysts, dismiss that problem because they say that loans are less than 10% of the loan book, property loans. But they're not factoring in other parts that are related to property, including the local government financing vehicles, which have at least $9 trillion of debt, which is about 12.5% of GDP. So there's a huge problem that the central government is washing its hands of, and I think they're going to be in an awkward position in the future.
Yeah, I want to touch on the social unrest question in a moment, because that's an interesting point that you raise. But in terms of, let's assume you're correct and there is a default later today, what is the contagion risk? Do you feel that next week we might be seeing stories about banks being in trouble?
Well, that's the key question. Now, the central government has the ability to slow roll defaults in the banking system. They've been doing this for several decades. So they will step in quietly, and there may be, in some cases, for a local bank, there might be some sort of merger, or for a state-owned bank, like the Bank of China, where I used to work, there could be something where they delay payments within their system. So that contagion risk won't be like the United States financial crisis, which rolled through in a matter of basically months, and then squashed mortgage holders and then moved on. That's not the way it works in China. So the control of the banking system will be less of a short-term contagion risk, but more of a steady downturn.
Yeah, banks obviously too big to fail in this case, but what isn't too big to fail in the wake of contagion risk from a Vanke default?
Well, you've got, obviously Shenzhen Metro is in trouble. Shenzhen Metro is maybe a state-owned firm, but it's a local state-owned firm, and I think it's got private interests in it. So it's not really going to be defended by the Beijing. It'll be defended, if anything, by the Guangdong government or the Shenzhen government, both of which have 10 or 15% annual decreases in revenue from the collapse of land sales. So they're not really going to be interested in bailing out Shenzhen Metro. So then that's going to affect a lot of other people. And, eventually, remember in the 90s, with the SOE restructuring, 60 million people were made unemployed. That was a huge number, and they never really got their jobs back. We're starting to see that kind of contagion in terms of layoffs throughout the economy, but it's just not being reported, and it's all being quietly buried away.
How difficult is it for Chinese property developers to raise money at the moment in this environment?
Well, it's near impossible. Because basically everybody knows that the money will be used to pay back previous debts, and there's not a lot of construction activity. So I don't think a lot of people, I met a developer here in Hong Kong with mainland assets, and they were sort of saying, well, we're just trying to figure out when to sell. So I don't see a lot of capital raising occurring. Certainly with the international markets, I don't see a lot of that going on.
Do you think there's any end in sight for these property market troubles? Because it feels as if it's been circling the drain for an awfully long time now.
It has been circling the drain for a long time. Even since the construction boom 15 years ago when I used to run around China, I kept thinking, what's the demand for all this? You've had something like a $14 trillion drop in valuations, at least for the property market as a whole. Now, at some point, they'll get down to a level from, the peak was 1.6 trillion billion square meters of construction around 2020, and they have to get down to somewhere like 500 or 600 million square meters, but nobody really knows when the bottom is. But, by 2026, you could see the decline slowing down. But we're still seeing a 14% annual drop in investment by the property sector, which is pretty significant.
Well, I said I'd like to circle back to the social unrest question. This feels like a good time to do it because, of course, the property market very closely linked to consumption, consumer sentiments, personal wealth as well. If things do start to get worse following a Vanke default, what do you anticipate is going to happen?
Well, Beijing so far, as I said, has steered clear and doesn't believe that there's that risk. Otherwise, they would have stepped in. I was told that to bail out Shenzhen Metro, the Shenzhen government cut the salaries of its workers in order to save cash for the bailouts. So that's an example in one of China's wealthier cities. Obviously, if you got laid off by a state firm and you owned your apartment for 20 years, you had a good 10 years of gains. So you're still in the money on those. So certain parts of the country, their attitude is, okay, it's bad, but we'll live. But these layoffs are in across different provinces, and they can be buried within the local governments and their security forces. So up to a certain point, you can have significant pain that's just not being reported or dealt with by Beijing.
So we've been talking a lot today and on other shows previously about the bright hope offered by AI investment and how China's tech sector is performing. Would you expect that this might be a way out of the mess?
Well, certainly there are some great companies that have been developed under the very, very intensive state investment schemes and EVs and DeepSeek and so forth. However, according to the official data, tech as a whole is about 9 or 10% of GDP, and property at its peak was 31% of GDP, including infrastructure. So it's questionable how much that can replace that. And the second issue is, let's say you have this booming EV sector, which you do. First of all, you've wasted a lot of money to get there. The estimate is around $200 or $300 billion. And second of all, that depends on exports. And you could have increases in Africa and Southeast Asia, but the big markets in the US and Europe are obviously getting more protectionist. So I'm skeptical that they're going to be able to export the way Japan did basically in the 90s. And Japan also was able to move capital to the United States and build auto factories. That's not going to happen under the current regime in the United States. So it's pretty tough to see how tech can really, really replace property. I mean, the main thing is you've got to start essentially defunding the state sector and letting private companies start to develop their own internal markets and rebalance to the consumer, which is not happening.
Well, if it's tough to see how tech can replace property, I've got an even tougher proposition for you. I mean, Chinese policymakers have long been wanting to rebalance the economy more heavily favoured in terms of domestic consumption. Can that be achieved as long as the property market is in such a parlous state?
Well, that's the first problem. I mean, there's a shortage of money and tax revenue for local governments. And the second problem is you're sitting there in Beijing and you've got all these elites who are tied up to the state system. You've got huge ministries, you've got huge state banks, and you tell them, look, we're going to start defunding you. Imagine how that would go over. It's not going to go over well. So, and I think Xi Jinping believes in state-directed investment. So he's perfectly happy to double down on funding chips and AI and other forms of technology. So I don't see any chance of that happening, even though the Central Economic Work Report claimed that they were going to try to rebalance. I just see no evidence of it yet.
All right, Andrew Collier, Senior Fellow at Harvard Kennedy School. Thanks so much for joining us today. Now, in other news, former TikTok CEO Kevin Mayer says he's confident the US majority ownership plan for the social media platform will unfold seamlessly. Mayer also told us it's a show of faith in Oracle, which is among the companies leading the joint venture.
I think it works operationally. I think having a company like Oracle, a very trusted company run by Larry Ellison, who's a trustworthy figure, obviously, being in the center, in charge of looking after and securing that U.S. data, that's crucial. And I think they're licensing the algorithm from China, so ByteDance will still own the code, but I do think this license will take another instance of the algorithm, all the code, put on Oracle servers, and then trained on the U.S. data that Oracle alone has access to. So I think it's going to end up having a vastly different feed and sort of content algorithm than you'll see around the world. So I think that will work. And I think that ByteDance will, is now below 20% ownership, 19.9% ownership. That's a substantial difference from status quo. And I do think that ByteDance has an operational role commercializing TikTok, selling ads, making sure e-commerce works and all the other commercialization factors. But really, it will be run by a U.S. board and it'd be a separate U.S. company.
Kevin,
it works.
It works, but the proof is in the pudding as to whether the algorithm is as powerful. How do you see, as someone who's in charge of content development and wanting to get your content out there in a marketing capacity, do you have confidence that it will be as good without ByteDance as heavily involved?
Well, I think it probably will be. There's a lot of intricacies and a lot of AI, right, that's the word of the day, in that code. And I think that code base being kept intact is crucial. I think had they tried to recreate a new algorithm from scratch because of security concerns, that would have been exceedingly difficult. That has taken years and years and thousands of engineers in China to develop this very sophisticated AI recommendation engine. So the fact that they'll have access to that, it will remain interoperable with all the other TikTok instances around the world. I think that matters quite a bit. And I think just retraining that same code base, that same algorithm with US data should provide a very robust solution. I think it will be seamless.
That's former TikTok CEO Kevin Myers speaking there with Bloomberg's Caroline Hyde. Up next, Seven & I's US arm faces pressure from the top to shape up in 2026 as it gears up for an IPO. We'll have the details next. This is Bloomberg. Welcome back. You're watching Insight. 7-Eleven operator 7&i is pressing its US convenience stores business to deliver a faster turnaround as the retailer seeks a public listing of the unit. For more, let's get to Bloomberg senior editor Reed Stevenson in Tokyo. So, Reed, tell us, Stephen Dacus wants improved performance ahead of this potential IPO. What does improved performance look like? What's he chasing here?
Yeah, indeed. I mean, the whole point here is to try and unlock value ahead of, offering a listing or new shares to investors. Essentially, what he's trying to do is improve margins as well as sales in an environment that's, pretty tough for all retailers in the U.S. Inflation is really hitting people's wallets. And of course, for a while, 7&i had chased a scale there with the acquisition of Speedway and Sunoco gasoline stations. But now he's really sort of pushing this message where they're trying to do several things. Number one is improving, the mix of private label brands, which have higher profit margins. Two is larger format stores, focusing on food as well. Three, cutting costs. And then finally, many of these outlets are in fact gasoline stations or petrol stations, and so essentially try to cut out costs because they're effectively buying at the end of the downstream market, trying to go upstream and capture some of the profits there as well. And so that's really just a message he's putting forth, to investors as well as probably the company itself as it operates in the U.S.
So, in terms of pursuing some of those goals, how challenging is it in the current economic environment?
Yeah, it's no easy feat. I mean, you have competition coming from really all ends of the spectrum. When you're talking about 7-Eleven outlets, a lot of the focus is now shifting toward food. That means you're competing for essentially against fast food outlets there. And then on the other end, a lot of consumers are going to like dollar stores and opting to buy goods there. And so really it's about delivering convenience but also value as well as food. Something that obviously 7&i has done extremely well here in Japan, and what they're really trying to do is do that in the US as well.
So can you tell us a little bit about the timeline for this potential IPO and any factors that could either bring that forward or push it back?
Yeah, so the second half of 2026 is what the company has indicated. Now, when we spoke with Stephen Dacus, he said they're not on a schedule and they want to see improvements in the performance first before they embark on an initial public offering. So we're just going to have to see how things play out for the company in North America.
All right, Bloomberg senior editor Reed Stevenson there in Tokyo. Let's take a look at how US futures are tracking at the moment. We are, of course, seeing somewhat of a decent rally in the Asia Pacific at the moment. So we've got US futures currently, if you just bear with me for a moment, E-mini futures are looking a little bit better to the tune of about 0.25%. NASDAQ futures also pointing higher as well. Dollar weakness continues to emerge as a theme after we did have the Fed ease very much as expected at its last meeting. January meeting very much up in the air, and of course that could be clouded somewhat by another potential government shutdown at the end of the month, which might lead to some more of those Swiss cheese data reports that we were talking about last week. However, for the moment, looks like we're heading towards a Santa Claus rally in the US as well. Well, Amazon Robotics says it's preparing its workforce for how tech and AI will impact hiring and career paths. Its chief technologist told Bloomberg that the company is already using physical AI and robotics at scale to help employees.
When we think about robotics and you think robotics and physical AI at scale, when you ship millions and millions every day, just 1% of exception handling can kind of eat your lunch. So any tools that we have to help us with the exception handling, maybe one of the systems is not picking up a particular object right. So that learning needs to be propagated through our other manipulation systems. Or maybe a mobility system is having some bottlenecks because of the way the inventory is stored inside of the building. People have really good skills of critical reasoning and critical thinking and using common sense. So tools that allow them to understand the situation better, perceive their environment better through the use of robotics, and then have truly physical agents to help with that in concert with our employees is going to allow us to deal with all the exceptions that we see, every day, especially at peak.
Hey, Ty, just got about a minute left here, and I know we've talked about this with you before, and I think it's a fair question. You guys have addressed it about the impact on your workforce, and I wonder if it's smarter to think about maybe not that what you guys are doing in terms of automation, or other companies for that matter, that it means doing away with workers, but maybe it means that you will have to hire fewer workers in the future. Is that fair?
Well, first of all, Carol, any question you ask is fair. So I think it is fair to always ask those questions, and we should always kind of, have the mindset of people first, and which we do inside of Amazon. So what are we doing specifically for our employees? And I'm really proud of this. We're building better machines for them. We're listening to them. We're iterating on our designs. We're rolling out a tool set for them to use that every day at scale, a scale that's almost unimaginable when it comes to what we've done inside of robotics. We're upskilling them. We have a $2.5 billion pledge that we call Future Ready to prepare 50 million people for how technology will impact and change not only the nature of work, but also what their everyday lives. And we're also creating a safer environment with our robotics, eliminating the repetitive, the menial, the mundane, allowing machines to do the heavy lifting and the repetitive actions, and allowing people to work with them in order to use this beautiful thing here.
Still to come, we'll take a deep dive into India's property markets as investments hit a fresh record. JLL and Anand Rathi Private Wealth Management are going to join us for that discussion next. This is Bloomberg. Welcome back. You're watching Insight. The Indian government has pushed through far-reaching policy reforms in the final parliamentary session of the year, and that's as Prime Minister Narendra Modi seeks to bolster the economy in the face of trade headwinds. For more, let's bring in South Asia political reporter Swati Gupta. So, Swati, we've heard about some of these changes and the involves of loosening up the nuclear industry, the insurance industry as well. Can you give us the details on some of the announcements and others?
Yeah, so India had its parliament session this month, and they pushed through quite a few bills, including the one which opens up the nuclear sector to private firms and removing some of the liability clauses that it has had for years, which have made it very difficult for investment to come through in that sector. And the second bill that they pushed through was allowing 100% foreign investment for insurance companies. So now global firms, which were earlier capped at 74%, can completely own an insurance company. So that will, both these things will allow hundreds of billions of dollars to flow into the Indian market and actually boost the economy, which is much needed at this point.
Yeah, so why the urgency? These are being pushed through in a very short time span.
So India has not had a very good start to the year. It is still in very protracted negotiations with the US on a trade deal, and it is right now under 50% tariffs, 25% of which is a penalty imposed by President Donald Trump for importing Russian oil. So this will lessen a little bit of the hurt that India is feeling. In addition, the government has also made a few other changes to its tax regulations, as well as reformed some of the labor codes that we have. So making things a little bit easier, improving the ease for doing business in India, and also removing a little bit of the burden on the taxpayer.
Can you give us an update on the progress, if any, on trade talks with the United States? And in the absence of that, India has signed a number of other free trade agreements this year, right?
Yeah, so actually there is not a really big update on the US-India trade talks. They are ongoing, as are the trade talks with the European Union. But India has been pushing for a little bit of diversification. So they are right now, they've just signed a trade deal with Oman, and there is a deal with New Zealand that is going to be announced soon. But at the moment, it doesn't look like we're going to have a trade deal with the US in this year. So this will definitely now slip into the new year.
All right, South Asia political reporter Swati Gupta there. Let's take a look at how Indian markets are tracking, broadly following the risk-on sentiment that we're seeing across the Asia-Pacific at the moment. We've got the benchmark rising in early trade. Gains in private banks and Infosys. We see the bank index better by about 0.5%, but Infosys is leading the gains in the Nifty 50, up more than 2%. So we've got almost all of the stocks on the index are better at the moment. Well, India's stock market has become one of the calmest in the world, prompting a rethink of strategies among players in the derivative space. Bloomberg's Savio Shetty joins us with more from Mumbai. So, Savio, why has India's stock market remained relatively stable? And this is in spite of the heightened geopolitical tensions and also, as Swati was saying, a long delay on this US trade deal.
Hi, Paul. Thank you for having me. This is on regards of two things. One is the amount of FII selling that we've had this year. Foreign investors have sold, but that has been almost seamlessly swallowed in by domestic investors. We've had almost $17 billion sold by FIIs, and domestic investors have pumped in almost $80 billion. India doesn't seem to be the market anymore that gets affected by big, strong news. We've had geopolitical tensions. We've also had the ongoing trade deal, but yet it seems that we don't move more than 1.5% on either side. The current streak is also quite long. I mean, it's almost the longest since 2023. A part of it has also got to do with the number of option contracts that have been culled. Weekly contracts by the regulator have been culled, and currently we have only 2 of them in the market. So I think it's a combination of like some kind of maturity in the market and a lot of option contracts being culled.
So which trading strategies have been most affected by these market conditions, and how are traders repositioning in response?
Yes, that's an excellent question. Ideally, any strategy that has to do with selling of volatility, because volatility is already so suppressed, would lead to dire losses. So you would, I mean, previously you would have volatility at 13-14%, you would have a short seller coming and selling in. With volatility at 10 and at times even 9.5, most of the volatility selling strategies have now gone out of the window. We may see, I mean, in our talks with experts, we may see a return of trend following strategies where you have a sustained trend for more than 2-3 months that can take place. But in general, people are moving more into options buying rather than option selling, because in options buying, if you have low volatility, that tends to make it a very profitable entry point.
Well, we've seen a regulatory crackdown from SEBI. How has that impacted options trading volume?
there has been a huge impact. We've had options daily average turnover in notional falling by almost 35%. This is the first time it's ever happened since data that goes back to 2017. It's clear that India's option market is no longer what it was, say, a couple of years ago, or even for that matter last year. But we've seen some kind of pickup in the last 3 to 4 months. All of this hinges now on what happens to weekly options contract. We've had the regulators saying that there will be a consultation paper that comes in soon. The drift seems to be that weekly options are here to stay for now, but only time will say what happens in that regard.
All right, Bloomberg's India Equities option reporter Savio Shetty there. A new report from JLL says India's real estate sector is expected to reach an unprecedented milestone in 2025, with institutional investments soaring to more than $10 billion. That is a second consecutive year of record performance. Domestic institutional investors make up more than half of the share, while private equity players fuel the momentum with a 30% contribution. Well, let's get some more on India's property investment outlook with JLL's head of India Capital Markets, Lata Pillai. Also joining us is Sonali Rawal, International Business Head at Anand Rathi Private Wealth Management. Lata, I'd like to start with you and talking about the report you just released. A lot of records broken. Can you just run us through some of the highlights, the things that stood out for you?
Hi, Paul. Thank you for having me. I guess the fact that from the last 4 or 5 years, barring last year, I guess on an average, the investments, foreign investments or institutional investments into the country on real estate hovered around $4.5 to $5 billion. Last year broke the trend at around more than $8 billion. And this year, I think we've crossed it and reached $10.4 billion. And I think what is really interesting this year has been the emergence of the domestic institutional investment, which is more than 50% of the investment that has happened in the country. A few interesting highlights here would be the fact that bulk of the investment is in the form of equity and also in core assets. And office remains the dominant sector where the investment has really come in.
So office remains the most dominant sector. Can you tell us about how some of those other sectors are performing?
Always residential used to be the preferred sector that we saw investments coming into. Indian domestic residential business is a build-to-sale business, and you had a lot of investors looking at coming in for the development piece. You also had a bunch of public market issuances made by domestic developers, which actually increased the participation on the QIP side. And last year, that's what we saw a lot of it happening. This year, interestingly, there was takers for the office REIT stock, which is basically the public market platform for office assets. And this was what was really found a lot of investment interest. The other sector which saw interest would be the retail side. Again, there was a platform on a REIT platform on retail assets, and one saw participation in that asset class as well. The other one which finds a lot of favor is the logistics piece. Traditionally, the logistics piece has seen a lot of interest from foreign investors as well as in this particular space. And interestingly, on a platform basis, the largest investment that happened this year was on a data center platform, which was put together by a couple of very large international investors and a very large player in the sector in the country.
Sonali, I want to get to you as well and just get your view on how India's real estate market as a sector has performed this year compared to the rest of the market.
So with the real estate, there's always more of a concentrated rally that we end up seeing. Essentially, it's more, as Lata was mentioning, on the commercial side. So the rental yields play a very big role on the real estate investment as an investment. And on the residential side, you don't see too much of rental yield. It's more 6 to 8% on the commercial. And that's where, there has been some amount of uptake with the GCCs coming in and the logistics and the warehousing and the institutional investors showing interest more on the commercial space. You saw India's top 8 cities having about 16.3 million square feet of net office space absorption in the Q3 of 2025, and that's a 35% year-on-year growth. So what we look at in this particular year, compared to the equity markets, the commercial real estate has definitely done a little bit better. But this is also a trend of the real estate market. There are pockets of very high returns, and then there are also pockets of very low return. So it's a lot more volatile. So if an investor really wants to unlock this return, you have to get the right instrument as to which part of the commercial. Getting that right is quite key on the real estate sector, and which is contrary to maybe when we're looking at the Indian equity markets. Indian equity markets is more broad-based and more consistent, dependent a lot more on the fundamentals. If you see 5-year cycles of the Nifty comparing it to the realty index, you see the Nifty ending up giving double-digit returns on almost all sectors or all time frames of 5 years that we have. Whereas the realty index, there are certain time frames that it would do negative and highly negative, and there are certain time frames that you have got highly positive. So it's a lot more volatile is what I would say.
Yeah, well, as Lata was saying in the JLL report, I mean, we've had back-to-back years of consecutive records now for domestic investment. Considering how this sort of plays to the broader growth narrative in India, do you see that trend continuing? Can you tell us about your outlook for real estate?
So our outlook for real estate remains that it would be in concentrated segments of commercial and office spaces. The big cities, when we are looking at residential real estate, that would have muted growth because there is demand in the smaller ticket size projects, but you don't see a lot of them coming in the big cities. The focus is more on the bigger ticket sizes in the larger cities, and that we think that has reached its saturation point. There is a lot more supply than what is the demand, but the office spaces in tier 2 cities and commercial, that's where the opportunity lies, and it's more concentrated in those. There would be in tier 2, tier 3 cities in the residential space, but again, very, very pocket dependent. So overall outlook for real estate would be more on the commercial side and the focus on the commercial segment. So it's segment specific. You could see some growth.
Lata, I want to take it back to you because you did mention the enthusiasm from domestic investors, but how much interest is there from foreign investors in this sector, and are there barriers to entry?
No, Paul. I guess, while 52%, if you look at it as a percentage terms, it looks like domestic seems to be taking the lead. But I think there has been a substantial growth of almost 18 to 20%, even on the foreign capital that came into real estate. So, in fact, one feels particularly optimistic that, the interest that we see is, and, one thing which I would want to mention here is that couple of things. When an investor comes into the country and make investments in any sector, they are looking for reasonable exit options. And that is something which has been provided very interestingly by the REIT space, especially on the commercial real estate piece. Many investors who have been making investments here have been able to get profitable exits and been able to do substantial sizes of exits from the market because of that. And I think that is what is fueling the continued optimism of foreign investments. And last year, if you look at 2025, almost 66% of these investments of 10.5 billion has happened in the last 2 quarters. That is after we had certain political uncertainties, certain macroeconomic headwinds. I think there was a slowing down in the first 2 quarters, which really kind of the last 2 quarters have really seen that being abated and investments coming through. Few other things which I would like to mention here is the development of the REIT platform, has really helped in building the confidence of investors, both domestic and otherwise. Recently, there was a regulatory change that was made that actually classified REIT investments as equity. What it really does is higher market participation in this particular asset class. You will see, index funds also being able to invest into this particular asset class. This is an asset class which allows investors to invest into commercial real estate, as Sonali mentioned, with the liquidity that usually an equity market provides, and that is really what has attracted the interest. And you have found a lot of takers for this. And as far as the other sectors, sorry.
I was just wanting to bring Sonali in on that point as well, because there are plenty of opportunities for foreign investors to get involved in the Indian growth story. But this is something we've been raising a lot on Bloomberg recently. We have a chart to show it as well. Just the amount of foreign capital outflows, particularly in the last quarter of 2025. But as you were saying, the longer-term narrative around India's growth is a solid one. Do you see foreign investors making a return next year, particularly as the US dollar softens?
So when it comes to the foreign institutional investors, there's a lot of factors that end up playing out, and I think one of the biggest ones remains geopolitical uncertainty, and I think the big factor of the return will be the US-India trade deal. That is the single largest risk, I think, that we have for the equity markets or the India growth story, because all of the domestic factors are there. There is domestic growth that is taking place. There are consumption measures that have been put in. There you are seeing domestic institutional investors coming in, investor behavior completely changing, looking at growth and not just fixed income assets, which used to be in the past. So if you have to look at it, all of the ingredients are there for the growth story to unfold. What lies is the external factor of coming into a conclusion. It's the uncertainty of what's going to happen and how it's going to play out is what is been spooking the investors. And of course, with growth coming in the US as well, having good yields there, that has also obviously led to some amount of capital continuing to go back. This 2025 was, as earlier was mentioned as well by Mr. Shetty, that we've seen $17 billion go out, but the domestic growth of $80 billion has really led to a lot of the equity markets staying buoyant. 2026 could be a year of reversal, but again, a full 100% or a 90% conviction isn't there until we get some amount of clarity on the US-India trade deal.
Okay. Lata, just before we let you go, I'm curious, was there anything in your report about investment in data centers in India?
Yes, of course. I guess that is something which has caught the interest across the world, and India is not to be left behind here. As I mentioned, this year as well, there were large investments made by an Asian fund. Most of the data centers are development of data centers because there aren't too many assets which are built which can be traded. So it is primarily in the development sector and the development side. And you have investments and a platform, as I mentioned earlier, of almost 11 billion that has been set up to build data centers in different geographies across the country. So data centers remain a big area of interest, both by domestic as well as foreign investors. More so foreign investors, I would like to say.
All right, Lata Pillai of JLL and Sonali Rawal of Anand Rathi Private Wealth Management. Thank you both so much for joining us. We have more ahead. This is Bloomberg. Welcome back. You're watching Insight. Here are some of the stories we're following. Cambodian media reports say Thailand's army shelled Cambodian territory on Sunday, including strikes on a temple. Earlier, Thai media quoted the military saying F-16 fighter jets launched Friday night bombing raids on a Cambodian casino and a bridge being used as an ammunition supply route. The reported attacks come ahead of an ASEAN foreign ministers meeting on Monday. China has criticised the latest US weapons sale to Taiwan, saying it raises the chances of conflict between the two superpowers. The US last week approved arms sales worth up to $11 billion, including missiles, drones and artillery systems. China's foreign ministry says arming Taiwan puts the island's people on a powder keg. The US launched large-scale airstrikes on more than 70 targets across Syria, fulfilling President Trump's vow to strike back after the killing of 2 US soldiers. US Central Command said on Friday that fighter jets, attack helicopters and artillery targeted ISIS infrastructure and weapon sites. Defense Secretary Pete Hegseth posted on X, saying the move does not mark the beginning of a war, but is a declaration of vengeance. Bloomberg's been told the US is still pursuing a third oil tanker near Venezuela as President Trump intensifies an oil blockade on Nicolas Maduro's government. A source says the Bella 1 tanker is a Panamanian-flagged vessel sanctioned by the United States. The attempted interdiction follows the boarding of the Century's supertanker early on Saturday and the skipper on December the 10th. All right, amid all this geopolitical tension, we are seeing tailwinds for all the commodities you see on the board there. We've got Brent above $61 a barrel, gold and silver both hitting fresh records, silver up 3 1/3%. Before we go, here's a look at tomorrow's show. We're going to get the macro and markets outlook for 2026 with BCA Research Chief EM Strategist Arthur Budagayan with a focus on trade tensions between the US and China. That's it for Insight. This is Bloomberg.